Let's now quickly revise accounting standard 14, amalgamation. Amalgamation as a word, it's not defined under accounting standard 14 at large. It only says it includes amalgamation as it is defined under Companies Act 2013 and the word merger. The word merger is defined under Income Tax Act, and Companies Act doesn't tell anything about amalgamation as separately in the definition context. But in our general business world, we have four forms of corporate restructuring. What are they? Number one, amalgamation. Number two, absorption. And two forms of reconstruction. One is external, other one is internal. If two or more companies wind up and when new companies form to take over these two or more companies which are winding up, that's amalgamation. What is absorption? One existing big company eats another small company. Absorption. External reconstruction is where one company creates another new company and that new company is created with whole and sole objective of taking over this old company. That is external reconstruction. Lastly, we have internal reconstruction, which is company will not go through liquidation. There will be no incorporation also. Internally, it will reform itself to look like a better company. Internal reconstruction, we'll discuss it as a separate chapter. Whatever these three words that we use in our corporate world, amalgamation, absorption, external reconstruction, are all together covered in accounting standard 14 context what we are learning in CA. So amalgamation, absorption, external reconstruction. All the three are covered in the context of accounting standard 14. I hope you got it. Going forward. Now, when we see amalgamation, there are two parties in amalgamation. One, the small company which is getting wound up, which is being liquidated, which is being taken over. That is called transferor company. The big company which is taking over the business, which is receiving the assets, East Colo company. In East Colo company, in the receiving company, there will be two E's, transferee company. Accounting standard 14 is applicable to transferee company, not to transferor. For the one who's dying, no, accounting standard 14 will not tell how to die. Your choice, your convenience, table, stool, fan, jumping from the top, eating poison, your choice. However, you are comfortable. If you want metro station is also very close, that's your choice. Okay. Accounting standard 14 will not tell how to die. Accounting standard 14 will tell how to live. So accounting standard 14 talks about transferee company, not transferor company. And for the purpose of accounting, accounting standard 14 classifies amalgamation into two modes. One, amalgamation nature of merger. Two, amalgamation nature of purchase. How do we decide whether it is amalgamation nature of merger or purchase? Because this is told by AS 14. AS 14 only should tell how to call merger, when to call merger and when to call purchase. So under para 3E of AS 14, there are 5 conditions given. If all the 5 conditions are fulfilled, it is merger. Even if 1 out of 5 is not satisfied, it is purchase. If all 5 satisfied, merger. Even if 1 out of 5 not satisfied, purchase. What are the 5 conditions? Number 1, transferee company should take over all the assets and liabilities of transferor company, including reserves and surplus. Condition number 2, minimum 90% of the shareholders of transferor company should continue to be shareholders in transferee company. That's condition number 2. Condition number 3, consideration to equity shareholders of transferor company should be settled by way of issue of equity shares in transferee company. We cannot give them preference shares or debentures. If it comes to be a fractional share, you can give cash. But consideration to equity shareholders of transferor company should be settled by issue of equity shares in transferee company. Fourth condition, business of transferor company should be continued by transferee company. And the last one is all the assets and liabilities of transferor which are taken over by transferee should be at book value. You cannot change the values. You cannot change the, you cannot tell this I'll take at this agreed value, this I'll take at this agreed value. You can't. All assets and liabilities at book value. There is an exception. To bring in uniformity in accounting policies, if you alter some assets value, that's accepted. For the purpose of accounting, we will check only 3 because 2 conditions cannot be checked in our exam. One condition which cannot be checked, whether the business is continued or not, we cannot check. Whether 90% of the shareholders are continuing or not, we cannot check. We'll only check, are all assets and liabilities taken over? Is it at agreed value? Is it at book value? Number 3, is PC settled by issue of equity shares only? If these 3 are fulfilled, merger. If one of these 3 are not satisfied, purchase. They'll usually give the information outright. If they don't give, you should be able to remember this, apply this, and then identify whether it is merger or purchase. That brings us to the question, why are we classifying amalgamation into merger and purchase? Very simple. When we're doing accounting in the books of transferor, there is no impact. Whether it is merger or it is purchase, we follow GAAP, not even accounting standard. Based on gap, we apply realization, dissolution or liquidation approach. What used to do in dissolution of partnership, continue to amalgamation of companies also. However, if the amalgamation is in the nature of purchase, in the books of transferee, you apply purchase method. If the amalgamation is in the nature of merger, in transferee, you apply pooling of interest method. The big company, if it is merger, pooling of interest method. If it is purchase, purchase method. Is there a difference? Yes, there is. What is it? We'll understand slightly later in the same video. Now, going further, purchase consideration. What do you mean by purchase consideration? See, this is the small company, transferor, equity shareholder, preference holder, debentures of transferor company are standing around the company. We go in that gap, take assets and liabilities of the transferor and come back. They won't leave us go. They will Allah iktare. Just to escape, we'd have to give them something because that asset and liability belongs to them. What belongs to them, if we take, we'd have to give them. Whatever we give to equity shareholders and preference shareholders of transferor company is called PC. It doesn't matter what you give, it matters whom you give. What matters is whom you give. Anything given to equity shareholders or anything given to preference shareholders of transferor company is PC. To transferor companies equity shareholders, you give equity shares, preference shares, debentures in transfer, you give them cash, PC. To preference shareholders of transferor company, you give them equity shares, you give them preference shares, you give them debentures in transferee company, or you give them cash, still PC. But to debenture holders of transferor company, if you give something, it's not PC. It's not what you give that matters, it is whom you give. To equity shareholder of transferor, even if you give debenture in transferee, it is PC. To debenture holder of transferor, even if you give equity shares in transferring, it's not PC. Are you getting it? Very nice. To a knowledgeable person, even if you give 1 rupee, he'll make great deal out of it. To a beggar, even if you give 1 kg gold, he'll make a begging bowl and then beg from it. So it's not what you give, it's whom you give that really matters. To equity and preference holders of transferor, in whichever form you give it is PC. I hope you understood PC. An important warning symbol, if the transferee company pays liquidation expenses of transferor, pays realization expense of transferor, it is not PC. It is not included in purchase consideration. Very important point to remember. Methods of computing purchase consideration. There are 4 methods. 1. Lump sum. 2. Payment. 3. Net asset method. 4. Intrinsic value method. What do you mean by lump sum method? Under lump sum method, total lump sum amount is mentioned. This is PC. That is PC. Easy. They'll tell PC 10 lakh, PC 15 lakh, PC 20 lakh. Lump sum amount is given. Easiest method. Second one, payment method. In payment method, they won't tell lump sum amount. They'll tell 10,000 equity shares of rupees 10 each issued at 12.5. 5,000 preference shares of rupees 10 each issued at 12. These many debentures, this much cash. What is it? Each share will be given 8 rupees cash. They'll give data as to how much will be given to how much. Multiply these many shares multiplied by this much is the issue price. This much cash for each share. Multiply and then take the total. The grand total amount is nothing but PC. Under which method? Payment method. Which method? Under payment method, we find the total purchase consideration based on the data given in the question. Distribution data is available, total it, payment method. Then we have net asset method. What is net asset method? Under net asset method, they will give the assets taken over data at the agreed value. They'll tell this asset you parcel, this is the money that I'll pay. This asset I don't want. So that asset which is not taken over, you ignore. Whatever assets of transferee is taken, whatever assets of transferor is taken over at whatever agreed price, you add. Whatever liability of transferor is taken over at whatever price, you deduct. So assets taken over at agreed value minus liabilities taken over at agreed value, if you do, you'll get the net assets taken over. This might or might not be PC, but this is the base. We'll find the net agreed value of the assets taken over minus agreed value of the liabilities taken over. We get what? Net assets value of that company. To this, if we add goodwill, what is mutually agreed, it will become PC. Or we can deduct capital reserve also. We can pay something more than that, or we can pay something less than that. That will make us identify the purchase consideration. That goodwill can be a lump sum amount mentioned, or it can be computed under one of the methods what you read in your foundation. It can be computed under which method? Simple average method, weighted average method, super profit method, capitalization method. One of these methods can be applied. I hope you are aware. Very good. Then after this net asset method, we will go to another method called intrinsic value. See, the transferor company's PC for the assets and liabilities taken over can be settled by issue of shares in transferee. If I value only transferor company is questioning how do you compute your share value? There's a question mark on transferee also. So we compute net asset value kind of computation, not just for transferor, but for transferee also. Transferor company balance sheet assets at agreed value, liabilities at agreed value. Transferee company's assets at the revised values or agreed values, market prices, and liabilities at agreed values. When you do assets minus liabilities, you find the net worth, net asset value, or intrinsic value of transferee, intrinsic value of transferor. Divide it by number of shares. You will get per share intrinsic value of transferee, per share intrinsic value of transferor. You use that as a basis to identify the exchange ratio. Put transferee company share value in transferor, transferor company share value in transferee. That is the exchange ratio that should be used to identify number of shares transferee company should give to transferor company in PC. Further, that can be issued at par or at this intrinsic value or any other value. That should be mentioned in the question. Nothing mentioned, we'll assume intrinsic value, but that is something that should be given. I hope you understood intrinsic value method. And after we compute this, if PC is equal to NATO, very good. If PC is more, NATO is less, goodwill. If PC is less, NATO is more, capitalism. Am I right? Very nice. After this, we'll quickly move to accounting. First, we'll discuss accounting in the books of Transferor. Transferor is the company which is getting wound up. Small company, liquidating company. In this company, there is no impact whether the amalgamation is in the nature of merger or purchase. Irrespective of the fact whether it is merger or purchase, accounting entry is absolutely same. This is not as per accounting standard 14. This is as per GAAP, generally accepted accounting principle. It is called as realization approach or dissolution approach or liquidation approach. Stays the same even in merger and purchase. Number one, close all the assets by transfer to Reliance. The story is simple. Pack all the assets and the liabilities to one box and take that box, give it to transferee company. They will open the box, check, they will give the cash. Collect the cash, equity shares, preference shares, whatever, and then you walk back. When you walk back, just hear the sound. If they throw the box, you pick the box. If there are any assets not taken over, sell them. If there are any liabilities not taken over, settle them. Nothing mentioned. Assets are sold at 0 rupees. Liabilities are settled at book value. Conservative approach. Done. Then you come back. When you come back, you need to pay for the truck driver who took you 2 1/4 realization expense. After that, first you pay preference shareholders. Anything extra or anything less paid, capital reduction. Sorry, realization. Then after that, equity shareholders is there. No, you need to settle them. Before that, identify profit or loss in the entire process. Close realization account by transferring it to equity shareholder. Then write equity share capital reserve debit to equity shareholder. Or equity shareholder will be debit and accumulated losses will be credit. Then finally settle your equity shareholder with B series. Story. Now we'll discuss entries. Number one, transfer of assets to realization. Realization account debit to assets. Transfer all the assets whether taken over or not, including cash and bank balance. If it is taken over. Then we discuss liabilities taken over. What is the entry for liabilities taken over? For liabilities taken over, you should write the entry liability account debit to realization. Transfer all the liabilities whether taken over or not to realization account at book value. Items which will not transfer, share capital, reserves and surplus. Other than this, everything else. After this, you will give that box of realization to your transferee. You're supposed to collect money from them. Realization account credit. And you will debit the transferee company. Transferee company account debit to realization. This is purchase consideration due entry. After this, you will receive PC from them. Whatever form you receive, cash, equity shares in transferee, preference shares in transferee, debentures in transferee, debit all that, credit liquidators of transferor because they are the people who are giving you the money. Sorry, transferee company account, liquidator, transferee company account debit. Entry is cash debit, equity shares in transferee, preference shares in transferee, debentures in transferee to transferee company account. PC is received. Then I turn and I'm going. I hear the noise. If in case they throw the box, I'll go check the box. If box has some asset and if it is sold, journal entry will not be asset to bank. Journal entry will not be bank to asset. It will be bank to realization. Ignore profit or loss on sale. Ignore book value. Write the entry at selling price. Write the entry at very good. Same entry will come for sale of liabilities also, settlement of liabilities also. If there is any liability transfer to realization is not taken over by transferee, then we will settle it. What is the entry to settle? Very simple. Liability account debit to bank. Liability account debit to cash. Will not debit liability, will debit realization. Realization account debit to cash or bank. This entry will be written at settlement price. Don't try to write it at book value and book profit separately. Any profit, any loss, automatically it will go to realization. Simple entry, realization account debit to bank at settlement value. Done. asset not taken over, liability not taken over. Then I come back to pay realization expense. The truck who helped me pack, load, unload, come back, everything. When I pay transferor, realization to cash. When transferee company will reimburse it to me, cash to realization. If they pay, I will write no entry. If first they pay and then I pay them, when they pay, I won't write entry. When I pay them, realization to cash. Simple. When transferor pays, what is the entry? Realization to cash. When transferee pays, what is the entry? I will not write any entry. What if they reimburse the expense that I paid? When I paid, realization to cash. When they pay, cash to realization. What if they pay and I reimburse them? When they pay, I won't write entry. When I reimburse it to them, realization to cash. Simple. Realization expense paid is something. Then, whatever the money that I've collected from there and I've got, I'll pay to my preference shareholder. First write the payable entry, then write the payment entry. First payable entry, then payment entry. Payable entry. Preference share capital debit to preference shareholder. If you're paying premium, debit realization. If you're giving discount, credit realization. Preference share capital account debit, premium that will be debited to realization account debit to preference shareholder. Done with this entry. Finally, settlement, debit preference shareholder at that value, give them whatever you collected in PC, whatever is agreed as per agreement. You give them equity shares collected from transferee, preference shares collected from transferee, debentures collected from transferee, cash you can give. But remember to credit preference shares, equity shares, debentures, everything at issue price, not at nominal value. You should not show nominal value on security premium split here. Why? This is not your shares. Transferee company shares you collected and you passing. Security premium will be separately credited when you're doing accounting in the books of transferee, not in the books of transferor. After this, before you pay your equity shareholders, identify realization, profit or loss. Throughout you use realization, 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 realization. Take all the debits as plus, take all the credits as minus. Identify the balancing figure. Close it by transfer to equity shareholder. If it is profit, entry will be equity shareholder credit, realization debit. Realization debit to equity shareholder. If it is loss, entry will be equity shareholder account debit to realization. Understood? Balancing figure entry. Sometimes they can ask you to prepare ledger also. We can find balancing figures in. This is like your capital reduction account closed by transfer to capital reserve, but here transfer to equity shareholder. Then two things we had not taken from balance sheet: share capital, reserves. In that share capital, preference is settled. Now equity share capital and reserves, what is there? Close it by transfer to equity shareholder account debit. Equity share capital account debit, reserves and surplus account debit to equity shareholder. If there is loss, then you will write equity shareholder account debit to that reserves and surplus, negative item. Once you do this, equity share ledger account, equity shareholder account is the only account pending, rest everything is closed. Debit that equity shareholder, credit whatever you have with you. Equity shares in transferee, preference shares in transferee, cash, bank, whatever balance is there you give. By this we close the books of accounts of our transferor. Am I right? Now we'll go to accounting entries in the books of transferee. Transferee, two sets of entries. One, purchase method. Two, merger. I'll discuss purchase method. First to know the story. Number one, the story starts when we hear the calling bell. We receive the box. We keep the box. We unlock the box. Unbox the box. Assets, liabilities will pop up. Then we will give purchase consideration to our transferor company's liquidator, PC, in the form of equity shares, preference shares, debentures, cash. He will go. We will kick the box. Relax. Now amalgamation is over. We'll do DRUMS. If it is purchase, TRUMS. If it is merger, DRUM. D, debenture settlement. R, realization expense. U, unrealized profit. M, mutual indebtedness. S, Superman, statutory reserves. Let's start with the accounting entries. I'm doing amalgamation nature of purchase. Number one, I receive the box. Business purchase account debit. That box is called as business purchase. They call it realization. I call it business purchase. Business purchase account debit. Whom am I supposed to pay? Liquidator of transferor. I'll write business purchase account debit to liquidators of transferor. First entry. Then I open the box. Once I open the box, assets and liabilities will pop up. Asset account debit to liability to business purchase, because the box is thrown now. Asset account debit to liability to business purchase. Am I right? In this entry, if there is any difference, if the difference is debit, goodwill. If the difference is credit, capital reserve. Asset is recorded at agreed value. Liability is recorded at agreed value. Asset minus liability is what we get is actually net assets taken over. Business purchase account is created at PC. This difference what we get here is because of difference between NATO and PC. If the difference is NATO and PC, if it is debit goodwill asset, if it is credit capital reserve profit, capital expense and capital income. Done. So by this box is opened, assets and liabilities are recorded. Papa, this guy liquidator is still waiting. Shall we give him money? We have booked the liability here by crediting liquidators of transferor. Debit liquidators of transferor company account and give them whatever you want to give. What will you give them? Equity shares, preference shares, debentures, cash. Whatever you give, you credit. But remember, this time equity share capital, preference share capital, debenture should be credited at nominal value. If you issued at premium, premium amount should be credited to security premium. I hope you understood. Very good. What's after this? After this, we do DRUMS. D, debenture holder adjustment. Now, in the liabilities that we took over here, we might have taken over debentures also. That is debenture holder in transferor company. How can he be there even now? Company is only dead. So we debit the debenture of transferor company here. Yeah, if in case we promised him premium, credit sec. So if in case you are discounting, you are paying something less, sir. Sorry. This is recorded at agreed value. It's recorded at agreed value. If in case there is premium on redemption, you will take nominal value plus premium in the agreed value of liabilities taken over. Let's say 100 rupees is the nominal value of debenture of transferor. If you are agreeing to redeem it at 110, 10 rupees premium on redemption. Here, X% debenture account is not recorded at nominal value. It is recorded at agreed value. Nominal value plus premium on redemption agreed. That is the agreed price. Credit whatever you give them. If you give them equity shares, credit equity share capital. Credit preference share capital. Credit debentures. If you are issuing them at premium, credit security premium. If you give them cash, credit cash. If it is issued at discount, debit discount on issue of debentures. This is the settlement entry for debentures. D. Next, we have R, realization expense. Realization expense of the transferor should pay. If transferor pays, good, no problem. If transferor doesn't pay, if I transferee pay, I'm not getting anything in return. I will write the entry goodwill account debit to cash because I'm not getting any benefit, but I'm still paying. This is the point of difference in pooling of interest method. Remember, goodwill account debit to cash. D over R over U, unrealized profit. Before amalgamation, when transferor and transferee were two different companies, there is a possibility that transferee has sold goods to transferor or transferor has sold goods to transferee. In that goods sold, if it is not sold to the third party and if this inventory is remaining in the closing stock, on that we have to eliminate the profit. That is unrealized profit adjustment. How to remove? Depends upon who has sold to whom. If the big company, transferee, has sold to transferor, we call it downward. Inventory will be credited. Debit will be to P&L account. Why? I should eliminate from my profit. I am transferee. I'll eliminate from my profit. P&L account debit to inventory. My profit will reduce. My inventory will reduce. If it is upward, if the small company has sold the goods to me, if the transferor company has sold goods to me, then I will not get any value from them, but I'll still reduce my inventory. That will be debited to goodwill. Goodwill account debit to inventory. D over R over U over. Next is M, mutual indebtedness. If I owe money to transferor or if transferor owes money to me, it should be eliminated. Transferee, transferor, either of them owe to each other. Very simple, debit liability, credit asset. It can be bills payable to bills receivable, trade payable to trade receivables, creditors to debtors. Either ways, debit the liability, credit the asset. Last one, statutory reserve. The reserve of the subsidiary which they were supposed to maintain under some statute or law will be no longer be able to maintain by them because they are liquidating. So as a transferee company taking over their business, I'll take over this obligation of maintaining reserve. I will maintain reserve on their behalf. I will maintain reserve on their behalf. What will I do? I'll write the entry that amalgamation adjustment account debit to statutory reserve. Statutory reserve in balance sheet reserves and surplus. Amalgamation adjustment also will be shown in the balance sheet reserves and surplus as a negative item. It will stay for some time. After some years, what will happen? It will be reversed. You will write the entry, amalgamation adjustment will be credited, statutory reserve will be debited, and it will get closed. Whenever the time period obligation is gone. This is accounting entries in the books of transferee when the amalgamation is in the nature of purchase. Next, we'll discuss amalgamation entries in the books of transferee. If the amalgamation is of merger, what method to follow? Pooling of interest. First entry, same, business purchase to liquidator. Second entry, slightly same. You write all assets taken over debit, all liabilities taken over credit, you credit business purchase. But you would have taken over all assets, all liabilities, including reserves. So transferors reserves also you will credit. So there is no separate statutory reserve to be taken over. Assets of transferor, everything at book value. Liabilities of transferor, everything at book value. Reserves and surplus of transferor, everything at book value. Credit business purchase. Except the share capital, no, you've taken everything from transferor's company. Then balancing figure, whatever comes, no, debit or credit cannot be called as goodwill or capital reserve. Whether it is debit or it is credit, it will be adjusted against reserve. It will be adjusted against in purchase in the place of reserve we will be rating goodwill or capital reserve. I hope you understood. This is the differential part. Then we have unboxed the box also. Now we should discharge the PC. Same entry. You will write the entry liquidators of transfer to equity share capital to preferential capital to debenture to security premium to cash. You can give them this. You will write this entry. Everything at nominal value. Premium should be written to security premium. Point of difference. To equity shareholders, you can give only equity shares. Cash can be given only for fractional share. That's one point to note. But otherwise, entry looks same as purchase method. So we've received the box, we've unboxed it, we've taken assets and liabilities, we've also paid the liquidity. Once he goes, we'll do DRUM only. S won't come. We'll do only DRUM. S will not come. Why? Statutory reserve is anyways taken over already. Or I'll put yes and I'll later put an into mark. You remember in merger only DRUM. D debenture, R realization expense, U unrealized profit, M mutual indebtedness. Debenture entry same to same like what we have done in the past. We'll write debenture account debit to equity share capital to preferential capital to debenture. Whatever you give, if you issued a premium, credit security premium. If you issued a discount, debit it. Same entry. There's no doubt here. Understood? Debenture done. Realization expense. Transferor's realization expense should have been paid by transferor. If I transferee pay, I will write the entry not goodwill to cash. I cannot debit goodwill because this is merger. In the place of goodwill, I'll debit resource and surplus. Otherwise, same like purchase method. There's nothing. D over R over U. Unrealized profit. I can't be writing goodwill to inventory. It will be written as inventory credit, debit will be reserves and surplus. It doesn't matter whether they have sold to me or I have sold to them. You can adjust it against P&L or general reserve. I hope you understood. D over R over U. M. Mutual indebtedness, same to same. Trade payables to trade receivables, bills payable to bills receivable, creditors to debtors, same entry what we have understood in the past. Nothing new. Nothing we have done with DRUM. Statutory reserve entry will not come. Why? When we took over all assets and liabilities, including reserves and surplus, there only we wanted it taken over statutory reserve. There won't be any separate treatment needed for this. I hope you understood. By this, no, it's about 30 minutes, but we've spent, we've taken complete coverage of such a big unit and such a big chapter like amalgamation on the whole. If there is something that you'd have to do on alongside with this, there's a couple of unique questions in the study material. You would have to do that, and you would have to also do a small revision of goodwill, because nowadays goodwill will become part of the adjustment computation of goodwill externally under super profit method, average profit method, or weighted average or capitalization method. Other than this, you aced amalgamation, stay in the game.